been so interesting to watch the markets and the resiliency that we've seen, given the concerns about central banks. And by the way, the Fed as well as the BOC, both was somewhat surprising to the market, but the market really did not seem to move too much on the news. But let's delve into some of these details and understand what happens next. For that, Diana Avigdor is joining us. She is the portfolio manager and head of trading at Barometer Capital. Diana, great to be with you, and thanks so much for joining us. A lot to discuss.
Thanks, Catherine. Yes, lots to discuss. Nice to see you.
Thank you. Why don't we first start with the Fed? Of course, the BOC was last week, and I think that it was somewhat surprising in terms of the rate hike. We'll get to that, but let's start with what happened yesterday. And the U.S. Federal Reserve, very much as expected, on pause, but was hawkish in their tone, signaling that that we could see 2 rate hikes this year. That's not really what the market was thinking.
No, the market was not thinking 2 rate hikes, and what moved the market down and then actually flattened it out was the median of the dot plots. So the dot plot is where all the Fed members put out their expectations for this period, next period, and long term, and that moved up to 5.62. The prior it was 5.1 actually. So that went up 50 beeps, and that's what signaled the 50 beeps, which is 2 rate hikes of 25 beeps each. Now, the dot plot was created by Bernanke in the financial crisis as a means to be transparent. And, those are not set in stone and they can move around. The market over the years, participants have taken it as something that they should trade on. Now, I would just highlight this, the Fed minutes in 2018, they called for a 3 to 4 rate hikes. And what actually happened in 2019 was that they cut 3 times. And if you recall, in 2022, in the beginning, they predicted Fed funds of less than 1%. And we ended up at 4.3%. My point here is, take it with a grain of salt. The Fed and all central bankers are just as data dependent as we are. And as data comes in, they make those decisions. Now, Canadian data, and I was pretty surprised that our central bank raised another 1/4 point. For some reason, the bankers need to, in my opinion, kind of wait a little bit. This has been the fastest rate hike in recent memory. Impacts take 12 to 18 months, and Bank of Canada as much has admitted it. Economic data is coming in softer. CPI in the U.S. is now 4% after almost being 10% at the high. So I don't understand why they don't sit and wait a little bit.
Well, I hear you, but let me ask you this, though. With respect to the Bank of Canada raising rates by 25 basis points, and it certainly was a surprise to, I think, pretty much everybody. But the reality is the GDP came in so much stronger than anybody had anticipated. I think that is one of the key reasons why they raised rates. At the same time, too, though, one would have thought they'd hold off given the high levels of consumer debt in this country.
Yeah, so that's exactly it. And in the U.S., you've seen some of the regionals already take a little bit of a beating in the private market, which has been so big. Private equity is now going through a process of, finding pricing, price discovery. And so there's a lot of moving parts and tightening inside the markets. Having a better GDP is a high-class problem to have. You've seen employment numbers in Canada. The last data point was negative, plus was expected. Right. And home sales, we're talking about, housing prices in major metropolitan centers in Canada have actually held in pretty well. But you see home starts and the retail numbers, they're coming in pretty weak. And so that should give indication that, I'm not saying that, I'm not making a call whether inflation is here to stay or whether it's more embedded than it should, but it would behoove everybody to just wait a little bit, see how it plays out, see how the data points coming in. I'm sure no central banker wants to break the employment market. So as long as pricing data comes in the form of CPI, but employment holds in, then maybe they can have a chance at a soft landing.